Well, good morning, everyone, and thank you for joining us. My name is Marlis Carson. I'm on the NCFC staff, and we recognize that there are a lot of unanswered questions surrounding PPP loan proceeds, both on the tax side and new SBA reporting requirements. So we have assembled a panel of experts here to help us work through those issues. If you have a question you'd like our experts to address, please submit it in the Q&A function at the bottom of your screen. Participants are muted throughout this, so you'll have to write in your question and we will monitor those. But let me introduce our panel today. Barry Jencik is our moderator. Barry is a CPA with Greendyke, Jencik in Rochester, New York. We also have Eric Krienert. He's a CPA with Moss Adams in Stockton, California. Ken Logsdon is an attorney with Dorsey and Whitney in Salt Lake. And Rebecca Toon is a CPA with CLA in Milwaukee. So I want to thank our panelists for joining us today, and I'll turn it over to Barry to get us started. Thanks, Barry.
Thank you, Marlis. Good morning, everybody. I think it's probably morning where everybody is. As Marlis said, the purpose of this webinar is to talk about really just a couple of specific recent developments affecting PPP loans and loan forgiveness applications and the deductibility of expenses incurred and funded with PPP loans. Without further ado, we're going to kind of dive right in. So we have hopefully time to go through the issues and leave enough time at the end for questions, because I suspect people will have lots of questions. If we can advance we have just a brief PowerPoint outline to page 3. You can see what we're going to be talking about. First, and Ken will cover the first subject primarily, which is these new Small Business Administration forms recently issued that are required to be completed in connection with a borrower's application for loan forgiveness. There's new forms 3509 for for-profit borrowers and 3510 for nonprofit borrowers. We will then move on from there to discuss the recently issued revenue ruling and revenue procedure by the IRS, Revenue Ruling 2027, Revenue Procedure 2020-51, where the IRS is essentially doubling down on their position that PPP funded expenses are not deductible. We can move on to the next slide. We thought the best way to do this is to sort of come up with a bunch of questions and kind of go through the questions, which will hopefully flesh out the issues and information that we think needs to be shared. So Ken, can you maybe go in a little bit to describing what these forms are all about, when they're due, what entities are required to file which forms, if you want to get into that a bit?
You bet, Barry. Thank you very much for that. So this part of this webinar will be focused on essentially loans that are over $2 million. That's what this is all about. The latter part of the webinar will be discussing tax applications that are generally applicable, but this component is for PPP loans in excess of $2 million, and it's applicable to for-profits and nonprofits alike. And what this has to deal with is the necessity question. Earlier on in the program, if you were tracking it, you would recall that you had to, in submitting your PPP loan application, certify that the PPP loan was necessary. And there was quite a bit of confusion and a lot of ambiguity around that. And we'll talk a little bit more about how that developed and how these new forms tie into that. But the forms we're dealing with here are Form 3509, and that's for for-profit borrowers, and then 3510, that's for nonprofit borrowers. And these forms are being provided by PPP lenders to the borrowers that have loans in excess of $2 million. And the overall purpose behind these is for the SBA to collect supplemental information that it will use in evaluating the good faith certification that a borrower made. And again, that certification, to state it, was, quote, economic uncertainty made the loan request necessary for ongoing operations, end quote. As for the timeline behind these forms, it's actually interesting. A lot of companies are getting these forms in their email, and the PPP lender is asking them to have them completed and submitted within 10 business days. It's interesting that, failure to deliver the forms within 10 business days could result in a determination that the borrower is ineligible for the PPP loan, that's a rather harsh consequence. But it's probably more likely that it would just jeopardize loan forgiveness and that the loan would be required to be repaid. There's also mention of other available remedies if these documents aren't provided within 10 business days. So we strongly recommend that you adhere to the deadline and submit all the information that you can to the best of your knowledge and in good faith, right? Not much different than the actual PPP loan application. There remains ambiguities, and we'll talk about ways in which you can perhaps address ambiguities or concerns you might have with any particular question. And I think it probably is worth highlighting that the forms are structured in a way that appears that this is not the first volley, right? I think that these will be the first round, in some cases, many rounds to follow for some borrowers for supplemental information and requests. So I would not view this as a one-shot opportunity to get it all right. I think what you do is you put together the information that you have, that's ascertainable, and fill it out to the best of your abilities. And if there are any uncertainties or ambiguities that you just aren't comfortable with, there's an opportunity for you to actually explain that in the forms themselves. So I think that's helpful. So I think timing is critical, but I don't think this is the end of the analysis. So I think the analysis for the SBA, so just bear that in mind. As for the content of the forms, they're broken down into kind of two categories: business activity and liquidity. So you have this activity assessment and a liquidity assessment. And if you run through those, they're rather telling, right? Under the business activity, they're asking for the borrower's gross revenue in the second quarter of 2020 and 2019, and there's some adjustments if you're a seasonal business. For nonprofits, it's structured similarly, but it focuses on receipts and expenses rather than revenues. And that's an interesting comparison. Second quarter of 2020 and 2019, you're asking yourself, is that terribly relevant? We'll talk a little bit more about what that really means. What is this information going to be used in more or less a hindsight analysis or a time of analysis? That remains unclear, but we'll talk a bit about that. Other questions under the business activity are, since March 13, as the borrower was required to shut down? Was it impacted by COVID-19 essentially? Did it voluntarily or involuntarily cease operations? Other interesting questions was there new capital improvements? And then at the end of this section, there's a 1,000 character limitation box in which you can provide additional context around any of the answers that you provided. And that would be an opportunity, if there's any ambiguity or concerns you have, to address those directly. Under the liquidity assessment section, this gets a little bit more specific. It asks about the cash and cash equivalents of the borrower as of the day of the quarter immediately before the PPP loan application. They wanted to see how much cash on hand the company had. And then it goes on to ask, between the period of March 13 and loan forgiveness, whether there were dividends paid, whether there was prepayments on other debt, during that same period, whether the borrower paid any compensation to employees or owners in excess of $250,000. And as of the date of the application, there's more specific questions: the borrower's equity structure. If it's a publicly traded company, what exchange? What's the market cap of that particular company? If it's a subsidiary owned 50% or more, there's some information about the parent company to consider and report on. Also, if it's a publicly traded company or a private equity firm or a VC capital firm or hedge fund that owns 20% or more, you have to disclose that. And also whether the borrower was an affiliate or subsidiary of a foreign company or a department, agency, or instrumentality of a foreign state. It goes on to ask a couple more questions, and one of which is there any other aid under the CARES Act, and excluding tax benefits. Again, another opportunity, 1,000-character limit, to provide any information or address any ambiguities with respect to the information that's going to be required under the liquidity assessment. There is a certification, as you can imagine. The person signing this better know that they're comfortable with the information they're providing, that they've essentially completed these forms in good faith, or rather the form. It's going to be one or the other, depending on whether you're for-profit or nonprofit. So take them seriously, but again, there's an opportunity to address some of the ambiguities. And I think that if you are concerned about that, I would use that, because that's a way to provide additional color around your good faith completion of the form that you're working with. As for general takeaways, I think it's helpful that if the borrower has information around the time they decided to go ahead and apply for the PPP that helped them make the determination that the PPP was appropriate, make sure you retain that information and those records. I know a lot of companies, especially larger companies, they did do kind of the drill of analyzing whether it made sense. They put together a case, presented it to their respective boards, and if they got the PPP loan, clearly they came to a determination that it made perfect sense. If any such materials were produced at the time, be prepared to share those, or at least reference those in your support and decision on getting the loan. What's interesting about this, and I think these forms are spooking, the PPP borrower community, if you will. And I'm not so sure it's time for alarm. I think the context is important here. If you recall the FAQs that are put out, essentially the ongoing guidelines with respect to the PPP, which came in many iterations over several months, one set had to deal directly with this particular issue, the necessity question. It was actually on May 5th, FAQ 46, if you're interested, that got into the details around the necessity question. Because it was so vague and uncertain, the SBA decided it was appropriate, even 1 month after the program went live, to address this specifically. And they ended up making two categories: loans under 2 million, loans over 2 million. And keep in mind, the 2 million category includes loans to affiliates. So if you have several companies that in aggregate their loans exceeded 2 million, they're going to be caught up and will be required to perform this exercise. And they essentially said, if you're a PPP borrower with a loan under 2 million, you will be deemed to have satisfied the necessity certification in good faith. So that was good news, and much relief to the PPP borrower community. But approximately right now, there's about 30,000 PPP loans in excess of $2 million. And that's the $2 million loans. It's unclear how many of those are under 2, but nevertheless, the affiliate and aggregation that needs to be done would put that number even higher, but it's going to be over 30,000 without question. But they made it clear that they were going to do an analysis, and they were going to make a determination if the PPP borrower lacked an adequate basis for obtaining the loan. And how do you do that, right? That's the real question that we had at the time that was published. Not much thought was put into what that was going to look like because everyone was just focused on getting the loan and making sure their operations could run smoothly and weather this storm. And here we are. This is what it looks like, frankly. So we've seen this. It was a long time coming. It's been since May that we knew that there was going to be additional inquiries. The fact that they're asking the questions that they're asking, I don't know if it signals a hindsight analysis, but I do think it's a way for the SBA to essentially have a list of very straightforward as they can be, questions that are broadly applicable and also pertinent, right? If you look at these questions, I think they're the right questions to be asking as to what was the state of the company before and after the loan application. As for the consequences, that FAQ goes on to even say that if the SBA determines that the company lacked an adequate basis for the PPP loan, it will be required to be repaid. The repayment schedule is unclear. It's unclear whether there would be an accelerated repayment, i.e. an immediate repayment, or would they just be subject to the standard maturity date schedule that was baked in, whether it be 2 or 5 years, depending on the timing of when the borrower received the PPP loan. But ideally, and in theory, the consequences that almost all of these PPP borrowers will face, and I'm talking about PPP borrowers that applied for the loan in good faith, and there weren't other factors that would jeopardize loan forgiveness. In theory, the consequences will be if the company was healthy enough that otherwise would, lend a reasonable determination that they didn't really need the loan, it would just be a repayment of the loan.
Ken, let me interject there with a question. Certainly the questions they're asking suggest that they are in effect using hindsight. If they're looking back at prior year and subsequent year numbers, when certainly I think most cooperatives were looking at the time they were making this decision whether or not to apply for these loans, kind of trying to look into a crystal ball with a really uncertain situation out there. I think a lot of co-ops documented. I know lots of co-ops legal counsels really held their feet to the fire to make sure that documentation surrounding the evaluation of uncertainty was done. I guess 2 questions. Number one, do you have any sense of how the weighing of those factors is going to be relative to this form, relative to that contemporaneous documentation that was done? And then for cooperatives particularly, you mentioned looking at dividend distributions. For co-ops, even now they're in the midst of this process that may be evaluating whether they should be potentially, if they're anticipating a forgiveness of income that might be patronage, they may be trying to contemplate whether they're going to distribute that income to members as patronage. And should they be factoring, is that a fact? Should this be factored in terms of if in the middle of this process, whether or not that's going to impact whether they get forgiveness? Any thoughts on that?
Sure. So I think you had a hindsight question and then, a question regarding what a co-op should be doing today if they're in the midst of contemplating a dividend or distribution of some kind. So let's tackle the hindsight question. In some respects, I don't know if it can be avoided, to be quite honest. As I was counseling my clients during this process on the front end of this program, I'd always say, look, this should not be reviewed in a hindsight, through a hindsight lens, but practically speaking, it's really difficult not to do that. When the SBA is looking for a determination whether a co-op lacked an adequate basis to get the loan, it's really difficult, I personally believe, to do that with just a single one-day snapshot, i.e. the day of PPP loan application. There's not a complete picture there. So I think I think people need to be prepared that the bar for in which you're allowed to receive loan forgiveness is probably a little higher, right? Once this information is put together, and there's a broader picture that will effectively include more or less a hindsight analysis. And I think that directly impacts your next question about dividends and distributions. First of all, if you're in the situation where you haven't exhausted the PPP loan proceeds, you know, that might impact the decisions you're going to make with respect to your other funds, certainly, right? If you haven't used all your PPP loan proceeds towards those permitted uses and you're starting to make dividends and distributions, I'm not so sure how that looks optically, but that's something that should be considered. Assuming the PPP loan proceeds have been exhausted in full, and here you are with funds on hand, and presumably the PPP loan proceeds assisted the co-op to weather this economic downturn, then you'd have to take a look at whether there is some kind of reasonable basis that the SBA will determine that the co-op lacked an adequate basis. If the co-op was able to get through the economic impact relatively unscathed, if you can look at your financials and make the determination that the PPP loan itself was really unnecessary, that probably would have been just fine. And there's companies and co-ops in that boat, right? There are PPP borrowers out there that in fact performed better during what was an uncertain time, but ended up being something a little different than a lot of what we expected. Then you might need to be prepared to repay that loan. And unfortunately, the timeline's what's really unclear. So it's going to be a little difficult for you to really make a solid game plan as to how you're going to make your dividends and distributions without knowing what the timeline might be if there is an eventual requirement to repay the loan. So I don't know if that information is helpful, but just, I think if you do have the cash on hand, if there is any question or some reasonable doubt around loan forgiveness, it is probably prudent not to go forward with sending money up and out if those are funds that you would otherwise need to repay the loan.
Okay, thanks, Ken. We're going to try to move on to the next topic, so we make sure we get adequate coverage of that, which is this new IRS ruling that came out, issued in November 18th. It was issued. Can we move to the next slide, please? So it was November 18th, I believe, the IRS issued Revenue Ruling 2020-27 and Companion Revenue Procedure 2020-51. 2020-27 essentially expands on the notice the IRS issued back in May, Notice 2020-32, in which, in that notice, the IRS, as you may recall, has taken the position that expenses that were funded with PPP loans are not tax deductible under the theory that because the PPP, assuming that the loan is forgiven, that income is considered tax exempt income, and under IRC Section 265, that those expenses are related to that exempt income and therefore were not deductible. So now we have more formal issuance with this revenue ruling of the IRS, essentially restating, doubling down on that position, but also making some significant changes in their analogy. Eric, do you want to comment? I guess the first question is the IRS in the ruling is using this language, reasonable expectation of reimbursement as a basis for those expenses being denied. Can you talk a little bit about what's different in terms of the analysis between 2027 and the notice 2020-32?
Yeah, I think the cases they cited and some of the explanation was, kind of around the attorney I don't know, for lack of a better word, um, trust funds where they advance fees and court costs and other things associated with lawsuits on behalf of their clients. Those cases basically were lawyers that tried to deduct those expenses in the year incurred, and then came back later under audit and said, no, they weren't deductible because you had a reasonable expectation of those fees being reimbursed. And so it basically it lines up along that. So the previous under the 2032, the analysis was you had tax exempt income and therefore you can't deduct expenses against tax exempt income. They kind of still have that as an alternative, but they've changed it. So now it's if you expect to get reimbursed, then you don't have an expense. You've got some type of deposit or prepaid or receivable or something along those lines. They didn't really articulate that, but something else on your balance sheet instead of an expense. And I think there's lots of questions about what's reasonable expectation of reimbursement. I think Ken did a good job of just scaring anybody that got more than $2 million about whether or not they're going to keep it or not. And so I think there's some questions there. But for a lot of companies, it was pretty easy for them to check the boxes that, especially over 24 weeks, that they spent it on the appropriate categories, most of which was obviously payroll.
Yeah, it's interesting. I think the significant difference in the analysis, certainly in the notice, the IRS, took this, the income is tax exempt income, based on the language in Section 1106 of the Act, the CARES Act, that said essentially to the extent that there's any income recognized, that income would be as debt forgiveness or otherwise included in gross income will be treated as exempt. Would imply that it's income to begin with, and then subject to exemption by virtue of the Act. I think the IRS, I presume, must have realized maybe there was some issues with that based on the language of Section 265, which talks about income being wholly exempt as a class of income, and certainly, and I think what Ken's talked about, certainly with this new form, you could certainly make the case that it's not necessarily the case that as a class of income, these PPP funds are exempt. It's going to depend on how the money is spent. It's going to depend on potentially the evaluation of the need, the necessity. So I presume rethought their legal basis and kind of jumped to essentially a position that's saying, well, these aren't really expenses that you're incurring if you're anticipating reimbursement, and they're analogizing. And I think the language they use in the ruling is reimbursement in the form of loan forgiveness.
Yeah.
And in effect, the forgiveness is really a reimbursement event, which it's a little bit strained, but I think, there's certainly some case law. I think there's a case back in the 80s dealing with an airline pilot that had training costs. I think it's cited in the ruling. Minaccio, I believe, is the case. We would recommend anyone to go back and look at that. That talks about an airline pilot incurring costs for training that were reimbursable. I think 90% reimbursable. He took a deduction for the expenses. The reimbursement wasn't included in income, and essentially the conclusion of the case, I think it was a tax court case, and I think it was upheld on appeal, that because the expense was reimbursed, the expenses were not tax deductible. Interestingly, in that case, the reimbursement happened in the same tax year that the expenses were incurred. It's a little bit different than the situation in the ruling. The ruling 20-27 deals with two situations, one where the taxpayer has not applied, a situation one where the taxpayer has applied in 2020 for forgiveness, has not gotten a decision by the end of 2020, and situation two where they've not even applied for forgiveness in 2020. And the conclusion the IRS reaches is the same in both cases. If there's a reasonable expectation of forgiveness, that the expenses are not deductible in 2020. That wasn't clear from the notice. I think a lot of people were of the notion that based on the guidance in the notice, that if the forgiveness didn't occur till 2021, that there would either be only a disallowance of expenses incurred in 2021 or some sort of a recapture, perhaps under the tax benefit rule in 2021. Now, with this ruling, it's kind of reversing that to say essentially these are not expenses if they're eligible to be reimbursed, and then, as you suggest, might be hung up on the balance sheet in some way. If we talk about the practical effect of this, you have a lot of co-ops out there that are now kind of in this difficult position, particularly fiscal year co-ops. Maybe they've already deducted the expenses in a fiscal period. Can I ask, Rebecca, do you have any thoughts on what co-ops should be doing that are fiscal year payers, the impact on financial statements, potentially, tax provisions?
Yeah.
I know I think you might have some real life experience with that.
Yeah, thanks, Barry. So with respect to that, I guess I'll kind of hit the financial statement impact maybe first. There's probably a fair number of cooperatives that had already issued financial statements prior to that ruling coming out. So I think from that perspective, really a financial statement impact, really nothing additional there to do at this point. But I do know I had several clients that had not issued their financial statements yet, and we're in the process of kind of getting that done as that revenue ruling had come out. So a lot of the things and discussions that we had revolved around, okay, well, what is the potential impact on the financial statements if those expenses are disallowed as in the revenue ruling, and is there a position that you could potentially take maybe under some other case law that you could maybe treat those as expenses, and kind of weighing through what those options are. Some of the things that were also considered is, let's just say, for example, I had a $4 million PPP loan and all of those expenses occurred in my fiscal year 20. Was there other mechanisms that I could utilize potentially to offset of that? Maybe we were passing through some DPAD. Did we not want to pass that through anymore? Or if we were pretty adamant that we wanted to pass that through, is there some bonus depreciation that we could trigger to help offset those? And really looking at what were all the various alternatives or options, and how did that impact our financial statements, depending on what the size of those loans were and how material it was.
Okay. What about, obviously now with a ruling being issued and even to the extent we had a notice out there, people are trying to decide what to do on tax returns that they're filing. There's arguably, you may have maybe a tax return filing position to still deduct expenses. But if you go down that path, what do you have to be thinking about doing?
Yeah. I think with respect to tax returns, there's just a lot of things to think about here. A lot of I guess from my personal experience with the tax returns, we're probably talking a lot of clients that significantly, or, cooperatives that have year ends that maybe were June, July, August, September year ends. I think the one benefit they have in their favor right now is the benefit of time. Because they do have time before they actually need to file those tax returns. And then if they needed to, there is that ability for extension. I know Marlis will kind of talk about maybe what might have from a congressional standpoint, but I think the key right now is, even if you aren't planning on filing your tax return because you do have some time to kind of maybe wait and see what happens, I think it's really important to be talking about what are the potential tax return positions, and what if you take a position contrary to the revenue ruling? What does that mean for you? What does that mean? And I think it probably comes in more context with some co-ops are used to kind of passing out those DPAD deductions to the extent that they are before December 31st. And I think having those discussions about what the potential positions are and the potential risk and benefits to those are is really key in this last month, to the extent that anybody is pushing out that DPAT. And if there could be any impact to that, what is that impact, and how does it affect them?
That's a good lead in, Eric. I don't know if you spent time looking at the question, and I know it's on a lot of people's minds, of, you know, how does this impact potential 199 cap A deductions if, you know, you have potentially expenses being disallowed that might include wages, you know, could include mortgage interest, rent, utility costs. The ruling doesn't really provide any guidance on, well, you know, if you have a pool of expenses that are subject to disallowance, which, and potentially, I think in a lot of cases, you have co-ops out there that you have a pool of expenses greater than the potential disallowance. How do you determine which expenses get disallowed? Is it, you know, do you do a prorata allocation? And this kind of gets into the 199 cap A issue. Eric, do you have anything you wanted to comment on about that?
I'm still crossing my fingers that we'll get a little bit more definitive guidance here. The one thing I'm kind of have spent time thinking about is, if I'm a fiscal 20 year in, you know, June, July, August, and October, you know, all the way through, I'm relying on my 2019 W-2s in order to figure out what my maximum DPAT is, assuming that I'm wage limited. And none of those wages, you know, really came into play. And so I think for our fiscal 20 clients, I think, you know, the deductibility or the non-deductibility of expenses has the potential to increase QPI, increase taxable income limitation, but not necessarily impact the W-2, because we're going back to 2019. At least I've been thinking about it that way.
Yeah.
And then, you know, how it impacts 2020 W-2s, I'm not as certain. I don't have a lot of, you know, I think we should be able to do it. We still paid it. We still reported it. It's not really, you know, based on the deduction. It's you know, the limitation is based on the W-2s issued. And so I think we can get there, but I'm a little uncertain.
There's a couple of thoughts I have. One is, if you kind of go down now the path that the IRS has chosen to take in this ruling to characterize these as costs that are reimbursable, then arguably, are they even expenses? You know, I had concerns under the notice with whether or not wages could be includable in the wage limitation. There's language in the regulations under 199 cap A B4B in the statute, which talks about that deductions properly allocable to qualified business income, and the regulations use the word deduction. So if, you know, you're dealing with a non-deductible, potentially non-deductible item, does that mean it's not allocable to qualified business income and therefore can't be included in the wages as part of the wage, either as part of the wage limitation? And then further looking at the language in this ruling that seems to suggest these aren't really expenses of the taxpayer if they're reimbursable, is that sort of further potentially put you in a position where you can't count those wages as part of your 199 cap A. My understanding is the Treasury is aware of the issue, but they obviously haven't opined on it at this point. So I think it's subject to interpretation depending on, you know, how you're going to look at this issue. You know, going back for a minute just to the you know, to reiterate, you know, you're from a tax return filing position, certainly if you were going to take a position contrary to the revenue ruling, you've got to think about penalty exposure.
Right.
You got to think about disclosure, filing an 8275 with your return if you're going to go down that path. There's a fair amount of commentators that think the IRS kind of got the analysis right under current law. The second time, that maybe the reimbursement analysis is has a better basis in law than, say, the Section 265 disallowance analysis. But Marlis, maybe this is a good point to sort of ask. I know you've got your ear to the what's going on in Washington, and you know, obviously we know that there's been statements issued by Senators Grassley and Wyden, kind of criticizing the IRS for taking this position. And we're, you know, I think obviously a lot of people hope this will go away with some legislative fix. What are you hearing?
Well, as usual with anything legislative, it's complicated. The House bill that passed earlier this year would provide the relief, the deductibility. And at this point, there are several Senate proposals. The big bipartisan bill, about $908 billion in spending, has that fix. The smaller bill that Senator McConnell sponsored does not. We understand it does not, but Republicans may be open to adding it to there. As you mentioned, some heavy hitters on the tax committees are supportive of it. Grassley, Wyden on the Finance Committee, and Ways and Means Committee Chairman Neal also supports including this language. So it is looking more likely that we're going to get a COVID relief bill. And if we do, and if they put tax provisions in it, then it seems fairly likely that we could get these PPP provisions. But sometimes as they're doing these big end of year bills, they just don't want to go down the path of tax because, there's so many things like tax extenders that could get included. NCFC obviously supports that, and we've signed on to letters to the Hill. And it's not just a co-op issue, it affects every industry, anybody who took one of these loans. So it's got support everywhere. So I think, if we get a COVID bill and if they consider at all putting tax in it, it's pretty likely that we'll get these relief provisions, but that's a lot of ifs.
Sure. I read an interesting comment somewhere that suggested that in evaluating, the provisions that had been earlier drafted to create a legislative fix, that the Joint Committee said there was no revenue effect to this because the expectation all along was that this was exempt income, and there wasn't because they didn't even think about expense disallowance. That's sort of was the expectation, that there wouldn't be expense disallowance until the IRS came out with their position. Is that accurate?
That's what I've heard also. Yeah, that they consider it to be no score to do this, so it shouldn't be controversial. Yeah.
So that would potentially be a big help in sort of getting that done. Okay, a few other issues before we want to leave time for people to have questions. A few other issues. What do you for cooperatives? What are the considerations from a patronage distribution perspective? Obviously, if for a lot of co-ops, many of which are on use book income as a basis for distribution. I think, and Eric, jump in here if you would like, or Rebecca, jump in. If I think most co-ops, if they've anticipating that if you have a forgiveness, that's considered income for GAAP purposes. Do you agree with that?
Yeah.
Yep.
So if you have book income and you're contemplating distributing patronage, but now you're faced with the prospect of having, let's say you had $1 million, or let's say you had a $2 million debt forgiveness, and you had $2 million of expenses potentially disallowed as a permanent difference. If you distribute that income and otherwise zero out your patronage, you potentially now have tax. You now have $420,000 of tax on a $2 million permanent difference. Is my math right? In that circumstance?
Did you say if you distributed it, I think you get back to zero, right?
Do you get back? Yeah, I guess you're right. I'm sorry.
Yeah.
Yeah, but if you keep it, then yeah, you got the income there. And one thing as it relates to that, I got a couple of October year-end clients, and we got hit with this notice right after we thought we knew what the answer was before that. But I'm telling them, let's, you know, because they pay on book and book is saying it's a loan. Then we got the income coming through in tax, and I think this is a perfect opportunity for the book butt and you know, have the board of directors rely on provisions that are in, I think, most bylaws that I've seen, that, you know, they've got pretty broad powers to make some changes and say, hey, this is a extenuating circumstance.
Mhm.
You know, we're going to, you know, pay it out as patronage, assuming that's what the co-op wants to do. I've had a lot of co-ops that said, let's just keep it as permanent equity too.
Right.
But assuming they do want to pay it out, then, you know, make that determination, you know, sometime here, obviously after their fiscal year end, but, you know, just as guidance comes along, they gotta make changes. So take advantage of the full 8.5 months and potentially pay that out, you know, down the road as it gets closer to that 8.5 months and we figure out a little bit more details here.
Okay.
Yeah, I agree.
Just briefly before we go to questions, talk about the Revproc 2020-51 and what the purpose of that is. Essentially, the Revproc, which they describe as a safe harbor, which I find a little amusing, but
literally the hardest thing to read in the world.
right. Essentially, the safe harbor is the revenue procedure is saying, well, if you if you have a reasonable expectation of forgiveness and you file your, you know, essentially, so you have a disallowance you take a disallowance in 2020, but then subsequently either decide not to pursue forgiveness or have forgiveness denied either in whole or in part, that you can deduct the expenses on the 2020 return, you know, assuming that you know, if you've extended the return, say, you can still deduct the expenses on 2020. You can go back and amend a 2020 return that's already been filed, or you can actually deduct the expenses in the subsequent tax year. So if you're a calendar year and incurred those expenses in 2020 that you disallowed, that you could, in theory, then deduct those expenses in your 2021 return. That revenue procedure only applies if you either don't pursue forgiveness or have forgiveness wholly or partially denied. Is when
Yeah, so you still got to go through the reasonable expectation analysis and
right.
assume that you can't take those deductions first.
I could actually see, I mean, it's maybe a long shot scenario, but I suppose it could happen if Congress were to flip and you had a tax law change put in effect and the corporate tax rate went up. There could be an advantage to having that deduction in 2021. That's probably not.
It brings up another good point. You know, there's quite a few fiscal year end taxpayers out there, and even we're so late in the game, even 1231 clients, that if Congress does act, it would be nice for them to act in a way that if people were trying to plan their income and, you know, plan this to be non-deductible and all of a sudden it's deductible, I think Congress should be thinking about giving a little bit of flexibility as to which year it hits too.
That's a good point. Certainly, you know, particularly where, you know, as you say, co-ops already made those decisions. So, okay, I think we've covered mostly everything we wanted to cover in terms of topics. I know there's a few questions that have come in. Marlis, do you want to go through what we have out there? I know there's some questions for Ken to address, I think.
Yeah, I guess, Ken, the number one question is, has the new reporting form been approved by OMB? And if not, is it premature for banks to be requiring it?
Good question. It was actually approved on an emergency basis. It was published in the Federal Register and still subject to comment. I'd be surprised if there's going to be material modifications to the forms. There might be a few tweaks. So I don't think it's premature. They're effective. The way the SBA is going about using these forms is a little curious. They're having the lenders reach out to the borrowers directly, but Then again, we're talking about essentially a minority of the PPP borrowers out there this is applicable to. So maybe that's to avoid confusion. It might be a smart move on their part. So I wouldn't look at this as being premature. If your lender reaches out to you and asks you to complete these, take it seriously and have it completed within the 10 business days.
Ken, are you seeing the banks reaching out before the borrower asks for forgiveness? I've only seen it after they've asked for forgiveness.
I've heard of a few cases where they're sending it in anticipation of forgiveness, which is frustrating in some respects. I mean, I presume most, if not all, PPP borrowers are going to be looking for loan forgiveness. But there might be cases where they're not. Again, that's probably going to be a very small set of borrowers out there. And they're still going to be required to do this drill. And I think it's probably the SBA would say, well, it's irrelevant whether you're anticipating full repayment as scheduled under the promissory note or not, because there is the likelihood of the SBA requiring a full repayment, in advance of that maturity date.
Barry, we had a couple other comments on this looking back and trying to determine need at a time when everything was so uncertain, sort of the unfairness of that for a taxpayer. So I guess I would just be looking to the panelists for comment on that and how you mitigate that. And also just encourage participants, if you have a question for our panel, we have a few more minutes, just submit them in the Q&A at the bottom.
What, if you think about, if you go back to what the underlying purpose, a big reason why these PPP loans were made available was, Congress wanted to incent companies to keep employees on their payroll, right? Keep paying people. If you didn't have these funds out there available, would companies have laid more people off because they maybe, particularly if they had to go into shutdown, they were paying people even though they didn't have a need. So you kind of look at that as the underlying purpose, that companies kept people on with these funds with the expectation that there wasn't going to be a tax cost to doing that. And now it seems like it's kind of, I don't want to necessarily say bait and switch, but I guess I just did. But there seems to be kind of a change in view of, or maybe not going back and thinking about what the underlying purpose was for making these funds available, at least as it was stated.
Yeah.
Ken, you have anything to add to that? Or Eric?
Yeah, I do. Yeah, I guess it's the hindsight question again, in some respects. And in fact, the next question speaks to this directly. They actually put up an analogy of getting a vaccine and then not getting sick, right? And I think that's a good analogy. I think that's important to remember. I mean, a lot of the conversations I had around this at the time of was one of the trickier things about whether a company really needed the loan is it's going to be difficult to determine whether it needed the loan because the loan is ideally there to help the company weather the storm. I think that's why these forms are focused on numbers, right? They're focused on how much cash did the company have. They're focused on whether there were parent companies that had cash that could infuse some kind of equity into the company to help it weather the storm. So I think you need to be prepared to paint a picture that without the PPP loan, there would have been problems, right? I think that's really what it comes down to.
Ken, do you feel that might be any more difficult for some of our cooperatives, that the agricultural sector was deemed to be essential? Do you know what I mean? And they were pretty much operating at as much of full capacity as they could, given the timing of everything. That's kind of come up in some conversations as well, if that could be an issue, because it was planting season, there was a lot to be done, and they were just working through what they had. Do you see that potentially being an issue for in the ag space at all?
It's unclear. And that's a great question. The industries that were vital, right? And should they be seen differently? especially due to, if you look at the certification, it uses the word, due to economic uncertainty, right? That's incredibly vague. So I think if you're concerned about that particular piece of it, it might be worth making a mention in the two boxes you have the opportunity to provide additional color in, to signal that that was part of the mindset of the co-op at the time of. You know, those, I think extra and additional information along those lines can be helpful if it's appropriate.
Yeah, and I think the other, and I'm not sure if you've had this question, but I know this has come up too several times. There's a specific question on the questionnaire that says, you know, between March 13th and the end of the loan forgiveness covered period, has a borrower paid any dividends or other capital distributions to its owners? And I think I think cooperatives are having a hard time on, like, should that be yes? Should that be no? Our patronage dividends that we were maybe paying from the prior fiscal year that just happened to be during our cover period, you know what I mean? Something we need to disclose. What if we redeemed a bunch of equities that we would have normally done, right? Just talking outside of COVID, outside of the PPP loans, you know, we're redeeming equities, we're issuing patronage in our normal course of business like we would. How do we respond to that? Is that a yes with an explanation? Is that a no? Like, what are they looking towards? And I think that's kind of come up too as a frequent question.
You bet. And that's a great question. And I would say yes, respond to it and provide additional color. You know, in that particular instance, this PPP borrower is a co-op.
Right.
The nature of the business, these types of dividends and distributions, redemptions perhaps, if applicable, are ordinary course. And that, I think that information is very helpful. And then that's another good point here. Co-ops are a unique kind of, you know, structure, right? Clearly. And the PPP it tries to be a one size fits all, but it is far from that. And the SBA guidelines and rules just don't work for all cases. And the SBA is sensitive to that. And they're going to be sensitive to different company structures, right? And I think a co-op is a great example of where they're going to have to take a different perspective on whether they give much weight to the dividend or distribution question when dealing with a co-op as opposed to a company that's wholly owned by a publicly traded company. To do otherwise would be rather silly, frankly.
I think you gotta somewhere in that explanation, remind them that you got a pre-existing legal obligation to issue patronage, and maybe tax law says you got to do 20% of that cash.
Good point.
Barry, we have just a couple of minutes left, and so a short question. Someone wrote, are forgiveness letters including accrued interest as part of the forgiveness amount? Anybody seen that?
Yes and no. Generally no, but if you got an EIDL loan, they've taken the position that part's not deductible. So if you got a $1 million PPP loan and a $10,000 EIDL grant, your forgiveness is going to be $900,000, $990,000. And so you technically owe the bank $10,000, and the letter I've seen had $10,000 plus a little bit of accrued interest on it. And so the PPP part for itself, no interest, but there was a little bit of interest on that EIDL grant part.
And Becca, did you see anything? Becky, have you seen anything different along those lines?
No, I have not actually. A lot of the things more that I've seen is I haven't really had too many issues where they've had the EIDL loans and the PPP, and the ones that have had EIDL loans weren't loans they applied for, they were fraud. So they're kind of working through that process. So, yeah, so, but you know, it has been interesting I did talk to a client just the other day, and this was actually personal fraud. Somebody had applied for one of those loans through them personally. it had his personal name. He's like, it's really funny because I'm trying to get this rectified because obviously we didn't apply for that, but we keep getting notices saying you now need to make a payment on your loan. So I think that's going to just take some time to work itself out. So I haven't really seen anything yet.
Wow, that's an unusual issue to have.
Yeah, so I think that may be a whole nother subject matter there, but definitely you're starting to see some of those repayments wanting to come in on EIDL stuff to the extent that there was more than the grant and things like that. So
Thank you. Well, we've reached our time limit, and if your question was not answered, we have a couple more in the queue here. Please send me an email and I will attempt to get an answer for you. But Barry, do you have any last wrap-up comments?
Just, I think this is probably a situation where procrastinating is at least from a tax filing perspective, is a good thing. Hopefully there'll be a legislative fix, but trying to push off decisions, perhaps if possible. I know that's not always possible, particularly with fiscal year cooperatives. But hopefully, if we can get a fix, that makes life, I think, easier for everyone.
Well, I want to thank all of our panelists. I want to thank Barry for giving us permission to procrastinate. I think that's great. And everybody take care and look forward to visiting with you again soon. Thanks.
Thank you.
Thank you.
Bye-bye.